Fed Chairman Powell highlights the importance of maintaining political independence when addressing inflation. Result of further interest rate increase. On October 10 at 9 a.m., Federal Reserve Chairman Jerome Powell spoke at a symposium on central bank independence held by the Swedish Central Bank. He emphasized the need of a central bank being free from political influence in order to effectively combat persistently high inflation. He mentioned price stability as an example of an unpopular but difficult decision. In his speech, Powell argued that low inflation is the cornerstone of a healthy economy and provides immeasurable benefits to the public over the long term. Increasing interest rates to slow the economy and restore price stability is a controversial move, but it is necessary in the short run. A clear direction for the interest rate policy was not hinted at in the speech. However, it did imply that further price hikes might be implemented this year. World Bank predicts 1.7% growth for the world this year, down from 3.0% earlier. The World Bank has warned that the global economy has slowed dangerously to a level close to a recession, estimating that growth will fall to 1.7% worldwide this year. The market's tightened vigilance and hawkish comments from Fed officials persist despite widespread optimism that U.S. inflation has peaked. Traders will watch Fed Chairman Jerome Powell's remarks, the December CPI 2 days later, and the start of fourth-quarter earnings season, led by major banks. With the slowing of wage growth confirmed by the U.S. Department of Labor's employment report last week, investors are looking to the December CPI to see if the price peak idea has any merit. On the 9th, Atlanta Federal Reserve President Raphael Boston told the Atlanta Rotary Club, "We will have to keep our resolution. We prefer increasing interest rates to the 5% to 5.25% level in order to reduce inflationary pressures caused by excessive demand. The ultimate interest rate should increase to a level slightly above 5%, according to San Francisco Federal Reserve President Mary Daly said. However, the precise number would depend on future statistics on inflation. He emphasized that it was too early to declare success, but he did anticipate that the increase might be reduced to a second consecutive 50 BP rate hike or a 25 BP increase at the next FOMC meeting. The first Federal Open Market Committee, FOMC, meeting of 2019 is scheduled for January 31 to February 1. Market participants anticipate that the Fed will raise its benchmark interest rate by 25 basis points, BP, at this meeting. U.S. consumers' predictions of future inflation rates, known as expected inflation, are showing signs of slowing. Despite the Federal Reserve's interest rate raise stance, optimism for a gentle landing is building as the central bank anticipates further declines in inflation next year. The New York Federal Reserve said that 1 year out, American consumers anticipate an inflation rate of 5%. The inflation rate is predicted to hit 5% next year. It hasn't been this low since July of 2021, and it's even lower than November's 5.2%. Since reaching a record high of 6.8% in June of last year, the inflation rate forecast by the New York Federal Reserve has been gradually decreasing. The U.S. Consumer Price Index for December, which will be released on the 12th, is expected to show a similar drop to 6%, according to economists' predictions. The wage growth rate, which the Federal Reserve uses as a priority in setting the benchmark interest rate, also decelerated last month, leading some to conclude that the economy of the United States is not in terrible shape and that a soft landing, in which prices are caught, is becoming increasingly likely. In light of these forecasts, the market is likely to price in a scenario in which the Federal Reserve raises its benchmark hike interest rate by only 0.25 percentage point at each of its monetary policy meetings in February and March, before cutting rates again after November. New York Federal Reserve officials have been rushing to voice their caution against such expectations, despite the fact that Chairman Jerome Powell has already confirmed during a monetary policy meeting last month that there will be no rate drop by the end of this year. With U.S. employment remains high, if inflationary pressures abate and business performance doesn't drastically decline, the Federal Reserve may reach a Goldilocks situation in which it may rein in inflation without causing a recession. The main index of the U.S. stock market has resumed its downward trend and may retest its low from December of last year as the U.S. dollar and government bond rates are technically close to the support line and are likely to bounce again. The fourth quarter of 2017 earnings season will go off later this week with reports from J.P. Morgan Chase, B of A, Citibank, and Delta Airlines. FactSet Research Systems, a provider of financial data and analysis, forecasted a 4.1% year-over-year decline in fourth quarter profits for the S&P 500, with the banking sector seeing a 12.2% decline. Please press subscribe and like.